Greetings, everyone. This is Jeff Scott. I think it's still the 21st, almost the 22nd here, and this is my weekend update. Decided to do one this week because I'm pretty sure next week my wife will have me busy because it's an important day for us, or at least for me, and she probably won't let me have the free time over the weekend because I'll be doing some traveling the following week. But anyways, this is my top-down review, and I entitled it, Are Banks About to Rumble? And I titled that because I'll show you some charts, but there's a lot of banks that looks like they want to break out. Here's my email address if you have any questions. The big guy's me. That's my trading buddy. I got a great dog, and he actually has to sit on my desk while I'm working, or he sits there and he cries. So it's kind of funny, but that's Boone, the trading dog. Disclaimer, this is for education purposes only and in recommendation of the Spirit of Education, not investment advice. I'm a doctor, not a broker. Most physicians lose money with their investments. I am not affiliated with any software vendor or trading company. Tools demonstrate those I use in my daily trading. I have paid for all the tools I demonstrate. No one pays me to say good things or bad things about anybody. I comment my thoughts. I have no filters, but I also have no conflict where someone's paying me. Trading involves risk. You and you alone are solely responsible for any investment decisions you make. I'm often asked, well, what is your style? Well, for the purpose of these programs, I do swing trading. I do some futures day trading when I'm not working, but for the most part, I'm a swing trader. I started with CanSlim with O'Neill. I thought Morales and Catcher had some excellent improvements to the basic O'Neill program of CanSlim and cup and handles. And then this is Ian Woodward and his sidekick Ron Brown to the right of him. And they really took a lot of O'Neill's principles, built it into the software program, highgrowthstock.com. And to me, that has been for 20 years, 15 years, the nucleus of my trading. Whoops. Over on the right is John Person. And John's very practical. He used to trade in the options pit in Chicago, owned a brokerage, author, created some great indicators. Great books, by the way. And what John really has taught me is, once I get a list of stocks, when to buy them and which to buy and when to buy them, when to close them, really about making the trade. He does some position sizing and money management that's actually similar to what I've learned from Van Tharp, who's the guru on position size and money management. And then down here is George Lee, who I've learned a lot of tips from over the years. He's a smart dude in the upper Pacific Northwest in Canada who I've shared the podium with and many times, and he has his own Pacific Northwest meetings as well. I have a lot of programs. You'll probably notice that on my desktop. Try not to be distracted. I spend a lot of time, probably too much time, with the analysis paralysis piece. But if it really push comes to shove, I need TradeStation and Thinkorswim. I find benefits of both of them. I also have Genesis, which most of you won't have, and I understand, so I don't spend much time using it. And then HGSIs for my interim post-market analysis, complemented by EdgeRater, a number of websites I use as listed here. HighGrowthStock.com, again, I am not affiliated. However, two things to point out is a free 30-day trial, and if you click on investing strategies, you'll see my name and a boatload of videos like this one. Stock patterns are cyclical. How quickly we went up to the top, and then this week, especially as we got to the end of the week, it started feeling like maybe the wheels are going to come off as, the realities of our current state in Washington. I mean, I'm in the camp that sometimes change is good. I think taxes are too high, regulations are too many. As a physician, I think Obamacare has some benefits, but really a lot of negatives. And I think change will be good. But I think change leads to risk, and risk could be have impact on the market. So I don't necessarily see the market rolling over, but I do think that the side of risk is starting to increase. That means I'm up here, and I have to treat the market differently, which is smaller positions, probably selling premium above and below price out of the market, and raising some cash. Not ready to throw it in and go bearish, but I'm going to get started last week at the end, and I suspect that this week I'll probably get less and less bullish on my positions. This is my sector review from Friday, and you can see here a sea of green. And frankly, except for healthcare and biotech, where again the concerns about pricing as well as some of the M&A activity, which seemed to drive price, showed their head during the end of the week, and that caused some weakness. Other than that, the market was very strong on Friday. If we look at the major markets, so these are two, this and the next one are from Thinkorswim, and on everything I do, I have a 17 in green, 50 either in yellow or blue, and 200 in red, period moving average. I like candlesticks, and I use on-balance volume as well. The yellow and the blue are John Person indicators, and you could see that, at least in Thinkorswim, E-minis, NQs, the third one on the right, are the YMs, and also the TFs, the Russell futures, all are in daily buy signals. That said, except for the NASDAQ, which is in a power move, the others have started to, well, at best case, go sideways, potentially start the process of rolling over. The VIX actually spiked early in the week, hit the 50-day moving average, and stalled and closed below it. So VIX is higher than it's been. Don't look like it's got any volume support for it, and we'll talk and look at it more later. And then here's the dollar. The dollar broke down below the 50, and that has implications for a lot of different things, and probably led to some strength in the Russell this week as the dollar was rolling over. If I look at the weekly, this is where you see it's almost hard to be bearish as we're near all-time highs on the S&P, the NASDAQ, the Dow, and the Russell. Again, the Dow and the Russell here may be flagging, maybe starting a rollover, and the VIX on the low side and the dollar rolling over. Sometimes I like to look at Genesis. Now, Genesis is some of the indicators fired differently. Across the top, this column here is the E-minis. The second column is the NQs. The third column is the TFs. Fourth column is NYSE. And the fifth is the YMs. And I like this because it gives me the ability just to see the different time frames. Clearly, for the most part, the markets are in an uptrend. We can see the weekly buy signals everywhere except for the NYSE. And interestingly, on Genesis, the E-minis, the Russells, and the NYSE have got person sell signals. As I've asked John about this from time to time. Different programs have different languages. There's some mild variations. Not surprising to see the sell signals. And we'll see which is right, the Thinkorswim charts or the Genesis. Rates, I think, are important because if rates start going up, that will slow down certain parts of the economy. They'll be good for banks, regionals, insurers. Rising rates ultimately should be bad for REITs, MLPs, utilities, dividend payers, and home builders. Rates had ran up sharply, and then both on the 10-year and the 50, they're sort of floundering around, but still way off up their lows. I look for AD lines to see if either perhaps the Russell 2000 or 1000, the mid caps, small to mid caps, and the large caps, are the AD lines rolling over. AD lines are strong, so the breadth remains good, at least in those. I look at percentage of stocks above the 200-day moving average on the left and above the 40 average on the day moving average on the right. And we're not quite in the middle, but we essentially are in an area where it's not giving me a signal of long or short. This is one that I watch closely. It's a 3-month new high, new low, and you could see that we've turned down from a pretty high number, 90% in the 3-month of the stocks making new highs, new lows, we're making new highs. We usually reverse hard when we get to the top or the bottom. This is sort of an early, and we'll see whether we turn around and go higher this week, or that's signaling some weakness ahead. The daily McClellan continues to show a divergence where we're getting essentially higher highs, but we're not breaking the zero lines on either the oscillator or the summation index, but there's clearly negative divergence there. The weekly, not as pronounced, but again, have failed at the zero lines despite a higher index. Other evidence that breadth might be weakening could be the buckets. Now, just to review, the buckets take all the stocks of the S&P 1500 and then divide the Bollinger Bands in 10% aliquots from 0 to 100, and then plus less than 0 stocks that are below the lower band, and greater than 1, those are above the upper band. And you can see 57% of the stocks here are below the midline, which is bearish, but you can see that there's more stocks in the lower deciles at the bottom part of the Bollinger Bands. Now, this again is a neutral signal, leaning towards bearish. When I start to see the stocks below getting to be 20 or 30%, not only will I know my portfolio's had some pain, but I'll know a reversal is coming. I look at the Hindenburg. The Hindenburg is a sign that historically we have not seen a major market correction without the Hindenburg firing, and I would look for multiple fires in a short period of time, and that would at least tell me the market's at risk. The way that Ian used to explain the HINDY, the professionals know the market's topping and they want to sell, and we are buying it, and there's lots of new highs, there's new lows, there's volume, there's turbulence in the market as it goes from the strong hands to the weak hands, and then the market falls. I also look at it in the Russell 3000 just to see if there's a signal there, and as you can see, we're below 0 in the McClellan. We have a rising moving average. We have plenty of stocks that are at new highs, but there really are no new lows, and no HINDY has fired since November. This is the Woody market indicator, and we're looking at this third column here. And the only the index that's green is the NASDAQ 100, and you could see this is clearly weak. If you go back to the strength in the market that we saw post the election, you saw how green it was. This is a great time to go long. Going into the election, there was a lot of fear in the market, time to be short. But whoops, you look at it where we're at right now, and it's all over the place, but certainly it's not a strong market by any means. And then sectors, there's really no sector that's in green. It looks like it's staples are red, and I can't tell if that's energy, but sectors are showing weakness as well. Now, the canaries are some leading stocks that I create, as taught by Ian, a custom index. And I look each week to see, because this will be often is a leading index, what the market's going to do. We have a failed new high on Friday. We had a red candle high on Thursday. That's not a great sign for the market. I think somebody commented on the Paltuma or Northern California IBD board about lots of failed breakouts, and that's kind of what you see here. So I'm going to be watching this. A rollover here will have dire consequences on the market. Just want to take a quick shout out about Ian. I've mentioned his name several times. Ian Woodward, may he rest in peace, passed away last year. And I met Ian in the early 90s with a company called Telescan when he was talking about top-down investing. Saw him live in a meeting in Atlanta, probably around 94, 95. And then I really latched onto him and followed him around for about 20 years, reading his newsletters, listening to his videos, and going to his live meetings. So I have the highest respect and admiration and appreciation for that person, and he certainly has been missed. And when I mention Ian, it's with great affection that I call him out. And for those that knew him, many of you feel the way I do as well. You need to know your news and EPS dates. It's a big week on tap for earnings. I didn't bother listing them. From a news perspective, and my source, which was Levitt Brothers, they now charge, and since I don't want to subscribe to them, I don't have it. This is a snapshot from Bloomberg, just calling them out. Hopefully they don't get mad at me. But basically, you got some GDP, you got some consumer sentiment, new home sales, energy numbers, Fed balance sheet, some housing numbers. doesn't look like a horrible week of news, but every week has plenty of news in it. I think the case here is now we're getting into the heart of earnings season. I also suggest you pay attention to this comment. This is a quote of me, and my quote is, "It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled." Should we worry about SKEW? This is interesting, and this is on the CBOE website in their blog. You can see I've highlighted the reference. And actually, Kaufman and Theotrade talked about SKEW last week. So to me, I guess SKEW is a abnormal volume of tail end puts. And what that means to me is that there are a lot of people buying a lot of out of the money puts on the S&P 100, and you'd only be buying a lot of out of the money puts if you thought there was a major risk to the market. So there are people out there that are expecting, I guess, a major correction in the market. 2 days in a row, January 18th and 19th, it closed above 140. It's only the sixth time in 27 years. This was the highest of SKEW in the last 6 months, ninth highest level since 1990. And I guess that's just a sign that people are getting concerned about a black swan event. So market thoughts, we continue to climb a wall of worry. Trump tweets will still lead to individual stock and sector impact. Trump's acceptance speech drew criticism of protectionist approach. Obamacare is being dismantled. We have no clear plan of replacement. And several of the Trump appointees, including Price, who's HHS or Health, struggled through hearings. The markets failed to break out this week, and growth stocks clearly underperformed. Is the low VIX that we've been seeing a sign of complacency before a market shock? Earnings and Trump tweets should be the news drivers this week. And last week we talked about the season of Netflix. It worked. I made some good money on it, and I'll show you my trade in a few minutes. But boy, oh boy, volatility crushes happen, and when the implied volatility is so high, even a call that was the right direction and picked the right price may not have made money because of the volatility impact on pricing. The usual top-down review. So last week we talked about Netflix, and we talked about how based upon the day of earnings that Netflix had, it depends where you look, 10 out of 11, 9 out of 10, 8 out of 10. And if you push it out a week, it was a 10 out of 10, but keep in mind the earnings were a week early this time. So I think this 10 out of 10 really reflects reality with a move that's as much as 35% predicted move. So we knew from seasonality, this is Magenta Trader. I know it might be hard to see that, so I apologize. We know from Magenta Trader that Netflix had a high likelihood of going up this week. And we know from the plain stock charts that Netflix has been in a nice uptrend. And this is the Wednesday, earnings came out, Wednesday night. And then Thursday, we had a big gap up. Actually, was much higher, closed above 140, and gave up a little bit on Friday. Now, a lot of times you have no idea where the price is going to be at the time of earnings. So I took my trade a week before I told you about it. So yes, I was front running, but not intentionally. I didn't even know I'd be doing a video. And I saw this flag, and when it pulled back into the lower line here, I took a trade on Netflix. Went a little bit lower, and then it bounced. There was ample time with this hammer on Monday pulling back on Wednesday to the 8-day to have taken the same trade. Now, how might you approach this? Well, I could have said, well, the stock's got an implied move of 11%, which would be about 12 or 13 points. I could have bought a call that was out of the money, that would have been cheap, and then hopefully it would double or triple. Now, a cheap, finding a call that's $1 or $2, you probably had to go pretty far out of the money, and odds are you didn't capture the win. I could have sold a put. Now, selling a put, when the stock goes up, you put the premium in your pocket. And on expensive options, that's kind of cool. I could have done call spreads, a bull call spread, where I bought a call close and sold a call further out. I don't do that on the Netflix trade because, well, I'll show you why when I show you the trades I took. The volatility crush on the near-term call, I've gone years where I've been right about the stock, right about the timing, right about how big the move was, but I did the wrong trade. And even though I was right, I didn't make any money. I could do a bull put spread if I'm really believing the market's going up, and again, keep the premium. The advantage of a bull put spread over just a put is that you buy a put below the price of the one you sell, and that reduces your margin requirement and reduces your potential loss. Many different things you could do. I decided to do a synthetic. So a synthetic has the same risk as buying the stock, but it's cheaper, and I can buy more at a lower price. So to duplicate the movement of a stock, I would need to buy the call and sell the put at the same price. So I looked on, this was the 9th, which would have been a week before the Monday after I told you to buy it. And I looked at a February synthetic at the money at 130, and I paid somewhere in the neighborhood of $1.65. Now, what that really meant was, this moved some since I did this. Actually, this is the trade after the move when I sold it. So looking up here, it meant that I paid a lot of money for the call, nearly $10 for an at-the-money call, which means the stock would have to move above 140 for me to even break even on this trade. But again, I have to the third week, Friday of February. And then I got paid $7.75 for the put. So you net out, I paid about 1.525 for the position, and that would be for a share. 10 calls is 1,000. Each call is 100 shares. So 10 would be 1,000 shares of stock. So I had to pay $1,525 to control 1,000 shares or 10 calls. Now, notice theta here. This is a very, very big number. And theta decay is how over time, how price erodes because of the premium, not the intrinsic value, the premium value. And by combining two high theta events, I end up getting a very modest theta. So there wasn't a lot of time decay that was going to hurt me. So I bought this on the 9th. I closed it 10:30 in the morning on Thursday when earnings came out. And as you could see, this trade per 10 calls was up $8,800. Now you might say, well, Jeff, that's only $8,800. That's not that exciting. Yeah, but I paid $1.52 to get that 8,800 profit. That's somewhere between 500 and 600% return in about 8 trading days. And again, no one says I bought just 10 calls. So that was my big trade. The downside of this trade was there was a substantial margin requirement, which got lower as the price went up. So you have to have a margin account. And the big risk here was the stock could have moved against me. Now, the neat thing is, I don't really lose money on the put until it's 130 minus 777, so it's about 122. Now, of course, I'd lose money on the call in that scenario. So I've had scenarios where I've given it time like this, that I traded below, my put became expensive, and then the stock traded back up. So I've only got limited protection here. In fact, since I paid $1.52, you could argue I have no protection. So the other option was to wait until we got closer. Why would you want to do it on a week and a half in advance? Let's do it on the day of the expiration, or the day of the earnings. So let's look at January 17th, which was Tuesday. I waited. This is the day before. Wednesday was the 18th when it came out. The 19th was Thursday. The 20th was Friday. Now that spread, I'm buying it, only has 3 days left in it, and it cost me about $3. Now, interestingly, combined, these two spreads ended up netting me out $15,980, and I paid $3 on this one, $1.50 on the other one, so $4.50 turned into nearly $16,000 of profit. Not too shabby. Now, let me pause it for a second. Now, we all have a great tool that we can use to do some of these analysis. So let's go into trade, type in Netflix. I still have some Netflix left, but let's now go into on demand. And let's look at Netflix, and I don't know why it stops at that date. And I'm just going to go to January of 2017. And let's look at Netflix on the 18th, and let's look at it at 15:30. Let's look at, it's now 3:30 on the 18th, and earnings are about to come out. So we'll have to give it a second. Okay, it is now 3:30 on the 18th before earnings come out. And let's look at a couple of trades that we could have considered. I like synthetics. I'm willing to take the downside risk. I could have looked at an option that has 2 days left. I apologize for this. This is a, let's see, give me the right price. All right, it takes a second sometimes on demand. I'll give it a couple more seconds. All right, it's made it. So what we could have done is we could have gone back into the same trade on the day of earnings. We're 30 minutes before earnings come out, and let's just buy this, and we're going to buy it at the market, and we'll just hit confirm and send. Remember, this is an on-demand, so it's make-believe. So here it is, the trade, buying a 3-day option, 2 days left, paying about $2.25. And now, let's see what would have happened. So now I'm going to go back here, and I'm going to make it the 19th. And I'm going to make it 0930. So now earnings are out. So catch up to what I just did. It's up to $142. And my spread is now up to $12.92. And had you taken this trade at the last minute and sold it at a smart time, you were up $10,400. You paid $2,250 to take the trade. That's a 4-to-1 return in 3 days. Now, that's riskier than many people would want to take, because you take the full impact of the stock. So let's go back to that 18th and look what other things I could have done. Give it a couple seconds to do its thing. All right, so we're back on the 18th. So another thing that I thought about doing, and I actually took, was an iron condor. So an iron condor is a combination of a number of different trades. And what I did was, let's see if I can pull that up here. It's probably too much for this presentation. I apologize if I'm boring you. So an iron condor, and I'm going to change it a little bit. I looked at that 130 price. And what I want to do is I want to, that's not the one I want to do, is it? Yeah, the iron condor I took got a lot more money, but I took it earlier in the week. So an iron condor, what you do is you buy a bull, you do a bear, you do a bullish put spread, so you sell premium and protect yourself with a cheaper put, and you do a bear call spread where you sell close premium, protect yourself with a distant put. I collected on mine about $8. It was 10 wide, and it was at the 130, 140 and 130, 120. So as long as the price stayed within 120 and 140, I would make money. Now, interestingly, at the end, I actually made a little bit on the trade. It expired worthless, which meant I kept, well, it expired worthless. It expired with me paying, I think, $8.50 back. So I ended up making, so I made back up. I got paid $8.50. I bought it back for about $8, so I made a few pennies. That did not turn out to be a great trade. What about if you had wanted to just look at a simple buy a call? And this is the easiest thing to do, and I think it's the most dangerous thing from getting hurt. So the price was at 130. Let's just look at this here. Let's drop that down. That if I looked at January 20 call at the money, well, at the money here is 132, I would have to pay $6.25. So had I bought that, all right, now I've got this 132 call. Now the advantage of the call is I have no downside. The challenge with the call, except I lose my premium, is that I've got to move $6.20 to even break even. And if we look at how we finished, and let's say I was smart enough to sell it almost right away. By the way, I was not smart enough to sell everything right away. And now let's see what happens if I sold it the next morning at 9:30. That call, it did fine. I spent what did I do? I bought it for 6, sold it for 10, and I made 4,000. So I invested 6,000, but my return was, as you could see, a much lower percentage. Now, a lot of people probably bought calls that were further out. And I know some people will look at that and say, I'm going to go for something that's a little bit less expensive. Let's go back to the 18th. And let's look early in the morning on the 18th. Let's get this thing to change. Okay, and if I looked at buying a cheaper put, like or cheaper call rather, at for example, 145, it's cheap, but the stock would have to trade to $146 for me to make any money, and I think we all know it didn't. So my message here is that it was a great trade, even though I front run you. Not really. You still could have taken a similar trade the next on Tuesday morning, or a trade at 3:30 on Wednesday before earnings, and there was money to make. So just to review, buy stock. You could have bought it, sold after hours at a higher level. You can't sell options after hours. The downside with buying stock is you have all the downside risk as well. You could have bought calls. As I showed you, even that call at $145 was expensive. You can sell puts and you keep the premium, but if the stock drops, you're in trouble, but you have no upside if the stock goes up. You could do various spreads, various combinations, but what I like to do is a synthetic stock. And what I'll do when I'm concerned about the risk, I'll actually buy a put that's out of the money to just prevent me from getting a catastrophe and also reducing my margin risks. So that was the trade I took, and that's my favorite trade of the year every year. And most times I make money. What was the killer was the early couple of years when I was just learning how to trade. And what would happen is I'd be right and not make any money because I bought the wrong option, or typically it was buying the wrong option, because it used to be Netflix was $700 a share. You weren't buying a whole lot of shares of that. I don't care how much money you have. All right, let's go back to the usual story. Go into my market force and divergence. Just take a look at the major indexes and get an idea of what this market is doing. Let's make this daily. That's because it cleans up some of my issues. E-minis in a buy signal. Remember, I'm looking at about 5 different things here in 3 different time frames. I'm looking at whether I'm in a green arrow up or a red arrow down. Person buy, person sell. I'm looking at the color of the paint bar. That's the elder impulse indicator. The way I use it is how he uses it, or how he taught us. If it's green, the buying window's open. I can buy or hold. I shouldn't be selling. If it's red, the selling window's open. I can sell or hold, but I shouldn't be buying. If it's blue, there's no signal. So I look at the arrow. I look at the price bar. I look at where am I within the envelopes, knowing that if I'm very high above or below, I'm going to come back within the envelopes. I look at my high jump bar to see how extended my stock is. And then I look for these little dots, red dots at the top or green dots on the bottom, that tell me there's some MACD divergence. So E-mini, green arrow up, daily, green bar, high jump's not a problem within the bars, no dots. Weekly, blue bar, but still in an uptrend. Yes, it's getting overbought. We see the MACD divergence. My sense here is we need more pausing to refresh or a pullback in the E-mini. It's getting a little bit extended, especially look at the weekly and the monthly. Next, I'll look at the YM, the Dow. Here, the Dow is in a sell signal, kind of like the Genesis. Blue bar, nothing here in the high jump. And you could see that on the weekly, not only did it get above the envelope, you had those MACD divergences there in the blue, although weekly and monthly are in a sell. So right now I've got a pullback in an uptrend, and we'll watch and see what happens. The NASDAQ, in a buy on all 3 time frames, blue bar here and MACD divergence on the daily and the weekly, and the high jumps up very high, suggesting that this is getting overdone. And the Russell in a sell signal, kind of like the Dow was, and you could see the MACD divergence and being out of the envelope earlier on at the end of the year on the weekly. So my sense here is that although nothing is horrible, it does look like certainly the Dow and the Russell are starting to turn over, and the market looks like it needs a pause. If I look at oil, I read somewhere that there's some big meeting with OPEC this weekend, and that Russia and Saudi Arabia are reducing output more than they were supposed to, and that's a sign that they're serious this time. I've only heard that for 40 years, so we'll see what happens. The dollar had run up, and then it's now in a sell signal on both the daily and the weekly. So the dollar weakness may impact things like the yellow metal, gold. In a buy signal since the 26th, in a weekly buy signal, went green on the weekly, still in a longer term sell signal. We'll look at it closer in HGSI. So that gives me a sense of the market. And now I will jump into HGSI, and I'm going to go into my warehouse view. I'm going to go into user groups, Woodward and Brown, Major Markets Plus, and I'll use my top-down view, which is all price and volume. And this is ranking strength of the indexes, mostly looking at the Friday, a little bit for the week, and just a little bit for the last 3 weeks. When you see the things like the gold that transports at the top, that's unusual of late. But I got the Dow, the NYSE, the mid caps up here, the NASDAQ and small caps in the middle, the Russell 2000 and the S&P down here, bonds and biotech weak, that's notable, and the dollar's the weakest. So it gives me a sense of where the strength is. I'll look at the S&P 500, and I'm going to go into a simple view. So what we have here is we've got an 8-day exponential, then my 17, 15, 200 simple. I've got my personal timing signal that I developed with a couple other people called the bongo. Weekly bongo is on the top. The daily bongo is on the red. And I know that when the weekly bongo is green and the daily goes red, as I have a pullback, and that I usually don't buy when the weekly bongo is red. And you could see in most of the period of the uptrend, it gets in a little late. You'll capture most of it by sticking with the bongo. So bongo's green on the weekly, pullback on the red. This is the Hindenburg, no Hindenburg. Well, you did have one in December on this tool. Certainly flattening out here. Pull back to the 200 here. Not much of a pullback. Will we go up? Will we take out our prior highs, which we hit about 2 weeks ago? Or are we going to come back and visit the moving average? We just have to wait. Right now we're going sideways. If I look at the Dow Jones Industrials, buying window closed. You can see the Dow Jones Industrials are rolling over. They did have a kahuna on Friday and more volume. Kahuna being a momentum indicator, usually not seen on indexes. It takes a fairly big move to see that. The NASDAQ, shooting right up this line, above the 8-day, still very bullish looking, although it is in a slight pullback with the daily bongo going red. Certainly the strongest what we've seen. And then the Russell sold off a lot on the this is funny. A couple weeks ago, I talked about expecting the Russell to pull back down, and that's what that box was. Let me kill that now because no longer applies. We have pulled back to the 50. This is a place where indexes like to bounce from. Not to say it can't go a little bit lower, but this would be a good place to see a bounce, a break from here, and you start to visit the 200 concerns. Hoping for a bounce. Looks like we got a little bit of a bounce on Friday. We know the dollar has been weak. We saw that in the trade station, and you could see the dollar has broken below the 50 pretty hard. And look at that, the weekly bongo on the dollar has gone red. Let's just look at this weekly bongo. I'm pretty happy with this. It would have got you in, and you would have rode up most of the way before you got taken out. It would have got you out up here and really kept you out the entire way down. The bongo, to me, is a very useful indicator. You won't find it anywhere but in HGSI. And a lot of volume, I think you'll see on Friday because it was option expiration time. So dollar is weak. The VIX has been low, but it's not on the bottom this week. Let's see what happened with the VIX. VIX ran up and failed, and its weekly bond go, daily bond goes red at a kahuna to the downside. VIX looks to me like it's going down further. When you see this, when the VIX goes up, that's pain. And your portfolio's unhappy. Then, once you go through the pain, then you see it coming down. That's fun on your portfolio if you're long. We're doing nothing right now. Not helpful. Let's look at the gold and silver real quick. Silver has been in a nice move for a little bit. To the high here, it was up 10%. From the low, silver is up 9% in 20 trading days. Like to see it get and hold above the 200. Notice the weekly bongo is still in a sell signal. If I go to gold, also in a sell signal, has to get above that 200. All right, so what do I learn so far? I learned the market looks toppy. Remember, tops are processes, bottoms are much quicker, and a process can go on for some time. So I'm not saying the market's about to fall. I mean, top's going for some time. I'm not saying the market can fall. That process can go for quite some time. But I do think the SKEW is further indication that at the minimum, there's more and more risk now. Next thing I do is I go down to 07, and I see that I have 173 groups, and I want to know what was moving up at the end of the week. So we have 59 groups are moving up, just to get a sense of the difference. Moving down, we had one group, which was the automobile index, and leading it down was Tata and Toyota. All right, not that exciting. So let's go back and let's look at the groups that are going up and see if we can find anything that looks interesting. Interesting, 1, 2, 3 groups are transports right up at the top. That's interesting. Oil, gas, services are here. Integrated oils are up high as well. Midstream, okay, steel stocks. Are these all the Trump stocks? I don't know. Maybe. Some of these are probably Trump stocks. Let's take a look. Marine Shipping Index. I don't know much about this group. This is the one that brought it up. And let me go to my webinar view where I add accumulation, distribution, the forces. This line is the high jump, Bible gap up, squeeze, mobile breakouts. This is OBV with its moving average. Above it are pocket pivots, and down here volume and kahunas. What do you say? The stock back here is doing 12,000 shares a day in November. 7 million shares up here. Had this day with 2 million, 4 million. Can you say plug? I don't chase these things. These things are crazy. Obviously, some people are buying them. I just don't trust them, especially when I go back in September, it's trading less than 20,000 shares a day. So it's an illiquid. There's something going on here. I don't know. I can tell you that this was not fun if you were on the wrong side of this trade, and it just feels the same way. I don't know any reason why these things should be going up. Now, perhaps because of us exporting natural gas, liquid gas, that we might see that change with Trump. Imagine what happens to the equation, Ukraine and Europe, if we become the supplier of natural gas instead of Russia. We have gas at $2, it's $10 or $12 there. It seems like you could ship it for $1 a unit and keep the difference. So this is Golar LNG. This is a shipper that ships natural gas. I find this one interesting. I find this many pocket pivots in a row interesting. And you notice the weekly buy has been green for quite some time on Golar LNG. Be careful with this group. They got whipped around not too long ago, and then they came right back down. Rail freight, this is interesting. CSX has bad earnings, and then the next day, one of their competitors, so here's their earnings date, announces he's retiring, and then the speculation comes in and says that CSX goes up thinking he's going to come and acquire them. I can't play that game. This was a big jump on news, and news that I think is nonsense after it missed earnings. I think I would pass. Union Pacific, earnings are out. Did have a gap up on the same news that came out. A couple of kahunas. Pays a 2.2% dividend. These guys are up on news. Kansas City Southern earnings came out Friday, I guess, or yeah. Let's see what happened. They missed, all right? So all these guys missed, and they trade up on rumor. That's hard for me to buy that. Canadian Pacific, I think this is the one he's retiring from. So rails look interesting, but it's news driven, so I'd be careful of that. Semiconductors, these have had some nice moves. I have number 2, 3, and 4 in my portfolio, which, since I just told you that, is the kiss of death. Skyworks had a great earnings call, great earnings numbers, Bible gap up. You know, if you believe in Bible gap ups and Morales and Catcher, it might be something you might want to consider looking at. Their numbers were outstanding. Pulled up everybody. Broadcom's already been in a nice uptrend. It too gapped up, multiple kahunas, pocket pivots, makes money, growth rate higher than its PE, pays a dividend. Acalero gapped up on earnings this week. It's got great earnings coming into the stock if it hits it. It does have earnings. I think their earnings came out already. Let me make sure. I certainly thought they did, unless they went up. They may have gone up because of the competitor. Let me take that back. Oh, they raised outlook. Okay. Right, so I think they just gave some. You don't come up and say you're beating your number and then fail. So they'll probably have a good earnings report out on my birthday, and then Cuervo moved up on the news from Skyworks. It's in the RFID business, I guess, range RFMD rather. Similar business to Skyworks. Good earnings per share growth. No dividend. Intel, looks like it's setting up to run. Pocket pivot, Kahuna Mobile breakout from a squeeze on Friday, 2.8% dividend. And then I like Cirrus Logic too, gapped up on Friday. It's also got earnings coming. It's in the same space. Look at the earnings per share. Look at the Kahuna, pocket pivot, mobile breakout from a squeeze. I just don't like the fact that its weekly bongo is red. So, lot to like in that group, and we could have gone further, I think, and showed you some. Oil and glass services. I own Halliburton in this group. I used to own Schlumberger, and at one point Atwood. After Halliburton got out of its Baker Hughes acquisition, of which both stocks have rocketed, I shifted from Schlumberger to Halliburton. And yeah, earnings don't look great near term. Earnings come out on Monday. So we'll learn a lot on Monday. I'm holding it. I looked at my risk. I thought we trade down to 53-ish on bad earnings, which is still about 6%. But my guess is it's more going to be dictated by the OPEC news that comes out, if it comes out overnight, about them actually going on their cuts. And let's see if it's before or after the market. think I'll be flying, but let's see. It is, no, the earnings are out. I take that back. No, earnings come out before market open. So I should know the earnings in a couple of hours. We'll see. I'm betting that it's going up, but we'll learn that the hard way. Let's see if I log in. I can't remember what my user and password is. Okay. NOV, I hate the fundies. I look at a company that did $5 billion a quarter. Now it's doing 1.6. But as it bottomed, well, it had a nice move off the 50. Everything is green. Mobile breakout, pocket pivots, 2 kahunas in a row. Earnings are the 7th. That looks interesting. Basic Energy, bottom fish. Noble. Looks like it's trying to make a comeback, although it did erase most of its Friday gains. And Riggs had a nice move up. Had a doji sitting on the 17-day moving average. Pocket pivots. I think I like Halliburton and National Varco better. Next one down. This is what top-down investing is to me. I've looked at the market. I'm now identifying the industry groups that look the best and some of the stocks in those industry groups. So gold makes it up to the top 10. And the question is, which gold do you buy and when? Earnings are starting to come into the stock, greater than the multiple. They pay a small dividend. It's more dollar related than company related. If the dollar weakness continues, American Barracks looks interesting. Gold Corp, you notice they've all come off their lows. Silver Wheaton, none look buyable right now. I'd like to see them move above that 200. Hecla Mining, probably the best looking chart of the bunch, has good earnings, small dividend. But it's probably not the leading stock. Notice the weekly bongo is still red. So miners don't look great. But I think if the dollar continues to be weak, then you'll probably be looking at miners. Just looking at something. Okay. Group number 6, airlines. Their earnings appear to be slowing down this year. I've been in and out of several of these. I guess for once I won't tell you which one I own right now. Southwest, probably the nicest looking chart, sideways. Had a kahuna on Friday. Noticed that the bongo weekly has been green ever since this day here. Would have been nice to have gone long Southwest when that happened. Delta, similar pattern, sitting on top of the 50 with a kahuna. Often, in my experience, stocks, after they've based, when they start to have kahunas coming in, is when they take their next leg up. American Airlines, similar pattern. United Continental, a little bit above the 50, but similar pattern of going sideways. All right, that looks interesting. I like the airlines here. Base metals. Aluminum's been on fire. Had something to do, I think, with Chinese cutting back and some tariff discussions. And you could see Donald Trump tweets, and every day this moves up. It's a little late to get into it. This is Century Aluminum, but what a move. Alcoa. Here's Freeport-McMoRan. Probably still buyable, more of a gold. And then some energy play, although they're divesting their energy assets. Great earnings per share growth. Here's Alcoa. Same thing as Century. Not sure what's spiking them. I think it was the things that I said. Even Peru or Southern Copper, it looks good. Diversified banks. Remember I said our banks getting ready to rumble? The earnings are pretty much out on the big guys. Wells Fargo, big up move on the election, pull back to the 50, moved up 3 days in a row, mobile breakout from a squeeze, weekly bongos green. Don't like what they did to their customers, but gosh darn, that chart looks pretty interesting right here. I'd like to see some momentum come in. Bank of America, again, sideways. Like to see some momentum coming in. Look at the earnings per share growth coming in. Deutsche Bank, don't know much about. Somehow we missed JP Morgan, and you see JP Morgan is pulled back to the 50 as well. These are just natural places for good stocks to bounce. I have position in some banks, so I'd like to see that happen. And then the less big banks, the regional banks. We'll look at a couple of these, and these two look like they're ready to rumble. Kahuna's 2 out of the last 3 days and a move up on Citizen Bank. SunTrust pulled back to the 52. Kahuna's a pocket pivot out of a squeeze. These feel like they want to run. PNC, US Bancorp, Signature. Look at this. It's already popping out. Mobile breakout from a squeeze. These look to me like they want to run. One way to play these is just to buy the ETF KRE. And how does that look? Exactly like the banks look. It pays a dividend, I believe. So the banks look interesting. And then lastly, in the top 10, entertainment content. Take a look at Viacom real quick. Stocks have been in a downtrend, lots of pocket pivots, big move up. Looks like Time Warner, nice uptrend pullback. Looks like it wants to run. It's an expensive stock. CBS pullback. I don't know anything about that industry group. All right, so what I've typically done through this top-down review is I start to create a watch list of stocks that I'm interested in. I also do a number of different scans. I end up with a buy watch list, and let's take a look at that before I say goodbye. Maybe we'll highlight a couple of them and show you what I liked about them. These are the stocks that made my buy watch list. First, let's go ahead and let's look at industry groups. Lots of semiconductors look good. As I said, I could have gone way below the list. Several REITs, including CyrusOne, an old favorite of ours, and Digital Reality in the same business, where they basically own the locations of where a lot of the servers are stored, colas, and they have a pricing power. They pay a dividend, great earnings per share growth. This one stubbed its toe, wants to run again. The weekly bongo went green as it came up here. And I think that this one looks interesting here as well, as does its partner. I'm not sure if they're partners, their competitor, Digital Reality Trust, similar pattern. Precious metals, two of the ones, the gold plays that I liked. And if gold goes up, I'll be looking at CDE. I like it. It's above its moving averages, had a mobile breakout, makes money. $11 stock. Technically looks better than the others I showed you. And then Royal Gold has to break above the 200. I wish the Bongo Weekly would turn green. On CDE, it turned green this week. So those are a couple gold stocks that made my list. Halliburton still made my list. And you see the rest. Really like the pattern on energy yield. Power generation utility pays a 5.9% dividend. Breaking off out of a squeeze, had a mobile breakout, pocket pivots, and Kahuna's. This is not a stock that you're buying for growth. It's been pretty flat for over a year. I think this is as much a split, spin-off, etc. as I don't think the stock dropped that much in a single day. I might be wrong. I'll have to go back and do a little bit of research. But you can see relatively stable, paying a 5.9% dividend, and looks pretty interesting here. And let's see anything else that I wanted to point out that I thought was a great chart. All right. So again, here's the list, and hope you all played Netflix and made some money on that. Several of you I know did, because I got some great phone calls and thank yous for turning people on to it. You know, when you see 9 out of 10, 10 out of 11, 10 out of 10, it gets me excited. And, you know, if you want to find more about seasonality trades, there's 3 programs. I showed you Magenta Trade screen earlier. Seasonality Trader and Best Choice. All of these are now web-based. Best Choice came out with a new version that's web-based, and this is Seasonality Trader. Let's see how many updates. No updates, good. So let's go back in here, and this is the one that we looked at last week, and I showed you that we were in a nice channel. We were right at the bottom of the channel on the 12th. This was the 9th, I think is the day I bought it, midline of the channel. And then my hope would be we'd be on an upswing and get this big up move. And you could see the green. This was a period of strength for the stock over the last 5 and 10 years, and it really did not disappoint. And one of the problems that we have here with Netflix is that Netflix earnings came out earlier this year than they did in the past. And you could see in the past it was buying on the 23rd, 9 out of 10, 29% average return. This year the earnings were 2 weeks earlier, or a week earlier, and that shifted the time to buy it. Now, one of the cool things about this program, let's see if I can show you, is this, is they have a calendar, and I could start to look for seasonally strong stocks. So let's start looking a week or 2 out, and let's say I only want to look at stocks that are 90% winning percentage and the change is 10% per year. And hit enter, see if they find any. And we are sitting here, make sure I got the January, and it is the 22nd. So Netflix showed up here because it's used to the earnings coming in earlier. UCBI. All right. DPZ, Domino's Pizza. Earnings are out February 24th. Okay. So this isn't really an earnings trade. But it shows if you buy it on the 24th and sell it March 8th after earnings, it's up 10 out of 10 years for a 13.2% return. Might want to look into that one. That's a little stock that does badly now. It's got too much news risk. I'm looking at DNR. I think that's another energy play. Not to February 28th, a little bit late for me for this call. But I'll search through and I'll see if I can't find some stocks. CMPR up 10 out of 10, 13.86. Ooh, that looks interesting. So let's do a couple things. And earnings, let's set it to earnings. Our January 5th, 25th, so it's this week. It's in a nice channel, going up. Nice. problem is it says here it's 1 to 0, only one time year of earnings. So let's see if this is an IPO, in which case I got fooled. Nope. Goes back to '06. So why is it showing me only 1 year? So when that happens, I'm going to go and look at it in a different program, just out of curiosity. Let's go into best choice. This is going long. I apologize. That's what happens when my wife goes to sleep and she leaves me alone, so I have plenty of time to talk. I'll try to remember how to, this is all new. Let me make sure I get this right. So I want to look at, I want to change that. All right. Hold on a second. I'm trying to remember how to use this. Oh, come on, Jeffrey. I'm sorry. It was right in front of my face. I have too many programs, what my wife would say. So best choice, it's telling me this is its seasonality graph on Simpress NV. Start date January 21st, which is tonight. Ending 12/4, taking the long side. 9 out of 11 years it's up. 14 days in the trade, 11 trades in 11 years, 80% win rating, average profit per trade 13.86%. Here you can see the percentage move as well as the dollar value change for the stock. So that looks interesting as well. So what I then do, if I like CMPR, and I'll finish this in a few seconds, I promise, those that are getting tired of listening to me, although you can always hit the eject button. Type CMP here, CM. What do I see? I see that I'm in a daily sell signal, and a weekly buy signal. I don't see a trade here on TradeStation. If I take out above this, I reverse to an uptrend, and the high of that bar is, so I have to get above 96.10 or so before that becomes interesting. I don't see a trade on this, but this is what I do, and clearly the numbers look compelling, and I just fish around looking for other great seasonal trades. On that note, I'm going to say goodbye. Thanks, everybody, for coming. I hope you all enjoyed the webinar. God only knows when the next one is. I'll be in Vegas during the Super Bowl. No, not because I'm a big gambler, but because I have to, why am I there? I'll be there because I'm giving a lecture in medicine. So contact information if you have any questions, hgsidoc@gmail.com. Safe trading, everybody. The professionals must know something with that high SKEW index. Be careful.